The US-China trade war has been quite the roller coaster. Donald Trump slapped tariffs on China, Beijing fired back, Trump doubled down, 145% tariffs on Chinese goods, up to 245% on some items. 245% tariffs. China hit back harder. And the cycle began in February. It continued for 2 months. Trump expected China to blink, but they held on. So the US, it seems, is starting to fold. First, they rolled back tariffs on consumer electronics, and now they're pushing for a trade deal with China. Reports suggest the US has reached out to the Chinese. But is the deal really in the works?
Trade war tensions between the United States and China are reaching new heights. At the heart of this economic chess game lies the global automotive industry, powered by giants like Volkswagen, BMW, and Mercedes-Benz. For years, these iconic German brands have poured billions into the US economy, building massive plants, fostering deep customer loyalty, and establishing America as a key production base. But things are shifting. Recent developments are sending shockwaves through the auto sector. While the Trump administration promotes America as a top-tier production hub, backed by high tariffs and nationalist trade policies, German manufacturers are increasingly steering their investments toward China. This signals a major setback for the American auto industry. So how did it come to this? Why is China, not the US, now the favored destination for German auto investment and innovation? Hey, before we dive into the details, make sure to subscribe, hit the notification bell, and join our live broadcasts to stay informed on today's most pressing global economic shifts. Oh, and a like on this video also goes a long way in supporting our work. So let's break this down. During Donald Trump's presidency, the United States adopted a more aggressive stance on global trade. The America First doctrine translated into sweeping tariff hikes, particularly targeting Europe and China, with automobiles caught directly in the crosshairs. Trump accused German auto companies of flooding the United States market, distorting trade balances, and undermining domestic competition. The threat of additional tariffs on German vehicles became a recurring theme. Unfortunately for these car makers, this escalation came at a critical, and honestly, pretty vulnerable moment for their global strategies. At the same time, US-China trade hostilities were intensifying. This led German automakers to reassess their global priorities, weighing where to invest, expand, and innovate. From Berlin's perspective, the choice became clear. China offered far more growth potential. As US tariffs introduced financial uncertainty, China emerged as the more promising, less volatile market. Volkswagen, Audi, Mercedes, and others began prioritizing China for new plants and expansion. Why? China's growing population, rising purchasing power, and aggressive government incentives, especially in electric vehicles and smart mobility, make it a magnet for auto investment. German carmakers are already seeing major revenue from Chinese consumers. By producing vehicles locally, they avoid costly import tariffs and win over buyers who actually prefer the Made in China label. This localization also helps them bypass regulatory red tape and, honestly, gain an edge over foreign competitors. Moreover, China is rapidly advancing in electric vehicles and battery tech. German firms are tapping into that innovation through research and development partnerships and local collaborations. In this context, adapting to China's booming market appears far more lucrative than, struggling against United States tariff barriers. Trump's tariff-driven policies have, ironically, made America less appealing for manufacturing investment. Unpredictable rules, shifting regulations, and the threat of sudden levies make long-term planning really difficult. Meanwhile, China's clarity about development goals, sector priorities, and investor support creates a more stable playing field.
At the same time, Bloomberg learns that Beijing may suspend tariffs on certain imports from the U.S. Now, markets set to end the week on a high, boosted by comments from 2 Fed officials indicating that U.S. interest rates could be cut. Plus, Alphabet earnings come in better than expected, boosted by Google ad revenue and an investment in SpaceX. Now, first thing is first, we have a lot to get through on the program today, but markets, again, I guess they're on tenterhooks on what happens with trade. And European stocks, but also Wall Street futures, did pair some of the gains. So a lot of them are still up, but a little bit less than they were half an hour ago. And this is because China has been downplaying in the last 20 minutes or so progress in its trade dispute with the U.S. So markets saw tentative recovery in risk appetite But again, if you look at European futures, that's being dampened a little bit. And that's also thanks to the White House's conciliatory tone towards China. That put assets up. Let's go to the European markets map. But then a little bit of pressure.
Of course, concerns remain. German companies are, still wary of China's joint venture requirements and intellectual property risks. But honestly, the draw of profits, the sheer market size, and all those incentives tend to outweigh those challenges. The German Chamber of Commerce reports that, many of its member companies see long-term opportunity in China. They're opening new production and research and development facilities to really sharpen their edge in global competition. Executives point to clear financial benefits. Manufacturing in China reduces logistics costs, helps avoid tariffs, and brings brands a lot closer to the consumer base. In essence, German automakers are asking, in a trade war between superpowers, where do we gain the most strategic advantage? So, according to a flash survey conducted by the German Chamber of Commerce in China from April 14th to 17th, 86% of 143 companies reported being affected by recent tariff hikes. Among auto-related firms, that number actually rose to 93%. Nearly 40% of companies are now speeding up localization in China, while about half are taking a cautious wait-and-see approach. Maximilian Butek, executive director at the German East China Chamber of Commerce, stated that this localization push will only accelerate from here. Germany remains the largest European investor in China, with firms like Volkswagen, BMW, Mercedes, and BASF maintaining expansive operations.
The biggest risk now is that the world continues to decouple. Of course, we have to stay in China to remain competitive. For the company itself, it's still a huge risk not being in China. We are welcoming a lot of CEOs coming to China. It's difficult to understand for anyone outside of China how innovative China became. And this mainly within the last 5 years, how rapid this development was and under high quality. It's also difficult to see how interlinked German companies are with Chinese companies here in the market. When they come here, they are all surprised how smooth also these corporations work and how efficient R&D, for example, or innovation can happen here in China. It used to be we bring technology to China, then we came to a stage we innovate in China for China, and now probably we see more and more innovations which come from China to the global. When you make it in China, when you survive in China, you can survive all over the world. China is changing so fast. It's more about, are you willing to learn and to get involved with China?
Data from Deutsche Bank shows German direct investment in China surged 12.3% year-on-year to a record high of 8.4 billion euros. While 9% of companies felt severely affected by China's trade policies, only 8% said the same of US measures, suggesting Beijing's actions may be more impactful for German firms. This is largely due to China's dominance in supplying critical components for auto manufacturing. Many global supply chains now rely heavily on China, and US trade restrictions, including export controls on semiconductors, risk crippling these networks. 43% of German companies reported operational disruption from these US controls, rising to 50% within the auto sector. Simultaneously, 35% said they were affected by China's restrictions on raw material exports. The survey found that US and Chinese tariffs had roughly equal impact on business operations, both cited by 36% of respondents as their most disruptive trade instruments. This paints a grim picture for the US auto sector. New plants in America could have created thousands of jobs and honestly revitalized the local supplier ecosystem. Yet, despite repeated calls from the Trump administration to build in America, German firms are calculating risk and, choosing China for medium and long-term investments. The United States is missing out on what could have been a powerful industrial revival, pushed away by its own protectionist policies. This has triggered political backlash. Critics argue that Trump's trade strategy is having the opposite of its intended effect. Rather than attracting investment, it's convincing global firms that the United States market carries just too much uncertainty. You know, this mindset actually extends far beyond just the auto industry, but it's especially damaging here considering the sector's size, its complexity, and the huge potential it has for job creation. Each German plant in the United States would have supported, honestly, hundreds of suppliers and contractors, creating these big ripple effects throughout the whole economy. But now, that opportunity is kind of drifting toward China. So now, those production contracts are heading straight to Chinese factories, and that's really boosting suppliers all across the region. And while tariffs might offer some short-term revenue for the Trump administration, the long-term cost of losing foreign investments could end up being way more damaging.
We begin with breaking news. China has just raised its tariffs against the US from 84% to 125% starting on Saturday. Beijing says it will ignore any further tariff hikes from Washington. Now, the news sent European stocks plummeting, and these are live pictures from the Frankfurt Stock Exchange of Germany's DAX stock index. The day had started optimistically for investors before Beijing's announcement, and the United Nations Trade Agency has said the tariffs will have a catastrophic impact on developing nations. China says the US should bear full responsibility for the global economic turbulence.
As the global auto industry braces for major transformation in the next 10 to 20 years, especially around electric and autonomous vehicles, there's growing concern that if the United States is left out of this shift, it may also fall behind in both technological leadership and economic competitiveness. German automotive titans are already moving to collaborate with China on joint innovation projects that could position them at the forefront of global mobility. It's no secret that German firms with operations in China are watching the United States-China trade war closely. This is a real-time example of how geopolitical uncertainty directly shapes the strategies of global corporations. In fact, these multinational manufacturers offer the most concrete answer to the question, who truly bears the cost of trade wars? Even if tensions intensify between Washington and Beijing, German firms are unlikely to walk away from China.
Welcome to China in Focus. I'm Tiffany Meyer. Our top story: U.S. tariffs are making a dent in China's economy. More on President Trump's comment about Chinese factories reportedly suffering.
Their factories are closing all over China because we're not taking their product. We don't want their product unless they're going to be fair with us.
Beijing is standing firm that it won't be first to reach out for trade talks with the U.S., but how are Chinese manufacturers faring amid the trade war? We spoke to locals in China for first-hand information.
The situation is extremely severe. We immediately couldn't handle it after those tariffs were imposed.
Instead, they'll likely maintain strong ties with Chinese authorities to protect their position in the market. As a result, when making investment decisions, many may simply respond to United States tariffs by pointing out, "We're already producing locally in China. We're not importing." This approach allows German automakers to limit trade-related losses and reduce their United States exposure, running completely counter to Trump's goal of forcing Europe to relocate production to America. Don't just stop with this information, comment, like, and don't forget to subscribe to our channel for daily updates on what's happening globally. Stay tuned.